Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at some of the key drivers of what has been very strong market performance across the globe over the past 6 months, 3 months, and 1 month, despite a surge in energy prices as a result of the war in Iran. We're going to start off with reporting season in the US, and so far it has been a very strong reporting season in the US. We've had close to 2/3 of S&P 500 companies report, and of those, close to 85% have beaten on the bottom line. Now, it's not often that you see close to 85% of US corporates beating on the bottom line. The last time that happened was 2021, and that was the highest that we've seen in 25 years. So we're close to record-breaking territory here, and it does indicate a broad-based good set of results. And it's not just that we've had a broad-based set of companies beating, we've also had a couple of companies that are very large with some sizable once-offs. If you think of Amazon as an example, or Alphabet and Meta, they all announced in the results that they were items worthy of attention. And as a result of these once-off, we saw a boost in earnings. And the earnings growth at the moment for Q1 is a remarkable 27% at this point. If we look at what it was expected just before those three companies reported, you're looking at a growth rate of about 15% or so. So you can see the size of those once-offs and how they've affected earnings. But US earnings growth at this point, very strong. And it's not just that it's very strong. If you look going forward, it's expected to continue to be strong. Earnings growth for the next couple of quarters is also expected to be above 20% year on year. Q1 next year, it slows a bit, but that's off a very strong base from Q1 this year. So it's quite categorically, even though we're not fully through the earnings season yet, we can say with some degree of certainty that it has been a very good reporting season, and we don't often see sets of numbers like this. And this goes some way in explaining the resilience and strength of the US market. As a result of all these numbers that have come through, the dividend yield for the US market is now sitting just a shade above 1%. It's not often that it's that low. In fact, it's only one other occasion in the past 35 years where we've seen a number that low, and that is back in 2000. So the dividend yield is very low, the PE is very high, in part because of these very strong earnings numbers that have been coming through. And again, that goes some way in explaining the very strong performance that we've seen from US equities and global equities over the past year. Bear in mind that European earnings growth is quite a bit lower than the US at the moment, but is also expected to pick up quite aggressively over the coming few quarters. And as a result of that, over the past year, and bear in mind a year ago, we were looking at the lows just post-Liberation Day, US equities up over 30%, and global equities up just a bit more. So over the past 1 month, 3 months, 6 months, and year, we've had performance roughly in line between the US and the rest of the world. And you're looking at pretty strong numbers and a pretty strong rebound over the past month or so. Fixed income hasn't done as well, and that's what you would expect in an environment where there's questions around inflation. And what's been surprising is the dollar hasn't strengthened a lot, despite all of the uncertainty coming out of the Middle East. So if we take a step back and we look at these very strong equity numbers that have come out, the performance from the equity markets, and the concerning numbers that have come out from fixed income, you land up in a situation where markets globally seem to be pricing in a combination of faster GDP growth, and that's what's supporting the equity market, and higher inflation. And that's what's been concerning the bond market. And that's very different from the sort of stagflationary concerns that were coming about when the war in Iran started to kick off. So instead of pricing in stagflation, the market is pricing in faster growth and higher inflation. And I think that is going to be the key question for markets over the coming year. How realistic is it to price in what has been good growth to continue with a combination of higher inflation, given that that appears to be the base case in markets at the moment? So first of all, let's have a look at GDP numbers. The GDP numbers for Europe and the US came out last week. Both were a little bit behind expectations. US growth on an annualized basis running at 2% in Q1, and Europe running at just a bit below 0.5%. It is important, however, just to dig a little bit for those US numbers, and you'll see that US economic activity did accelerate in Q1 relative to Q4 last year. Total growth running at the 2% number, up from 0.5%. And if you look at core GDP growth, which is just an indication of private demand, That number has been growing at 2.5% in Q1, and that's up from Q4 too, and showing little signs of weakness. So the consumer at this point in the US is still undefeated. And if you look at inflation, if you look at core PC inflation, it's quite clearly is the case that it is accelerating. So bear in mind, this wouldn't be affected by higher energy prices. This is core inflation. And core inflation is picking up to 3.2%. And if you look at core inflation over the past 3 months and over the past 6 months, that's been accelerating too. So that market interpretation of what's going on, of faster growth and faster inflation, seems to be borne out if you look at the latest data coming out of the US. And that's one of the reasons why we've upgraded our risk score. For some time now, we've been cautiously positioned globally for fear that growth would decelerate and we land up with a slowdown. That appears to not be the case. And in addition to that, if over the next 6 months we see an opening of the Strait of Hormuz, we would expect to see a further rally too. And given that, despite valuation, we've shifted our risk score back to neutral. And the way that we've expressed that is increasing our allocation to some cyclical sectors and reducing our allocation to some defensive sectors. We've also been reducing our exposure to some energy, given that we expect that energy prices will start to fade once the strait reopens, whether that be in the next 3 or 6 months. And we're also increasing our exposure to non-energy commodities, given that they should be beneficiaries of an economy which appears to continue to grow with higher inflation. Now, one of the reasons we've retained our underweight in US equities, despite these very strong earnings numbers, is that we do think that the dollar, even after recent weakness, is still pretty strong. If you look at the trade-weighted inflation-adjusted dollar, it's only on a handful of occasions in the past 50 years where it's been stronger than it is now. And in contrast, if you look at currencies that are weak, the one that stands out is the Japanese yen, and we've started to see some intervention from the Japanese authorities last week. So we've maintained our underweight in US equities, and we've maintained an exposure to Japanese yen on the expectation that the dollar will weaken over the coming 12 to 18 months and the yen will strengthen. And finally, in South Africa, despite the shock to global energy prices in March, South Africa had a trade surplus. It was actually a bit above expectations. And if you look at the 12-month trade surplus, that number is now at 250 billion rand. Now, this has been a positive impulse and channel for the SA economy for some time. It's one of the reasons why the rand remains relatively well bid. And it will provide some support, buffeting the SA economy, offsetting some of the negatives from higher energy prices. We need to bear that in mind. The positive impulse coming through from other higher commodity prices for the SA economy. We do remain overweight SA in part as a result of this. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.